Today's a little bit of a different episode because it's a case study of us exiting a position. The position is TWST Bioscience. We've held the position for about 3 years. The position has actually not made or lost us any money. We're almost flat. We lost very little money on it in terms of from initiation till today. Nevertheless, of course, it's a failure because for 3 years we've tied up capital and made no money. I think I want to use this episode to illustrate a very important lesson for everybody. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. So understanding when to get in and understanding much, much more importantly, when to get out is the absolute crucial key of this business. Everything else you do as a hedge fund manager is not, everything else is something else. So analyzing companies, a lot of people can do that. Consultants, analysts, so-called VCs, whatever they are, whatever they pretend to be, they can analyze companies, talk about companies, build investment theses. The whole of Wall Street is full of people like that. When it comes down to pulling the trigger, there's two things which are important. One is you have to have skin in the game, otherwise it doesn't count. I'm very much in the school of Nassim Taleb. If you don't have skin in the game, don't even talk to me about investing or, you're taking risk and all of that stuff. Skin in the game means your own money, your own livelihood. And if you don't have money, then at least your own job for real. So if you're a pension fund asset manager who, invests 2% of their assets in risky projects, which are not index linked or regulated, don't talk to me about risk management. If you're a VC that has 150 positions and you blow up every now and then make some, you throw shit at the wall kind of stuff, don't talk to me about risk. So this is the real thing. Going in there, putting your livelihood on the line, and then understanding when you're wrong. These are very, very difficult concepts. I want to talk about this and explain why it's so difficult and how we manage this at Orange Capital Partners. This is one of the most important episodes in this whole podcast series so far. Not in terms of content, like we've had some important episodes where we introduced our natural Sharpe ratio, where we spoke about sort of our definition of disruption, things that are really fundamental to the way we think. But this is a lot more important in terms of, for you guys out there, particularly the people that want to get into the business or want to become risk takers and wealth creators, you need to understand how to get out when you're wrong. This is so important. This is not even wrong podcast. It's November 16, 2022. This is Krim Delco. For the day, the fund is down 2.2%. The market is down about 20 basis points for the year. We're down 55.3%. The market's down 15.2%. We're underperforming by 40.1%. So let's lay down the situation. We invested in TWST Bioscience about 3 years ago and decided to exit the position today. It's been one of our, we don't have a lot of exits, to be fair. We hold on to our positions almost exclusively, but there are exceptions. This is a Poisson distribution. Sometimes it happens. We've had recent exits where definitely the most prominent ones were GoPro and Twitter, 2015-16 range. And then we had some reshufflings. We got out of Illumina. We sold CRISPR Therapeutics. We sold Editas. We had some positions in Microsoft and things like that. But I would say I wouldn't call them necessarily exits. Those were reshufflings, kind of cleaning up portfolio, changing our thesis a little bit. We had this big pivot a couple of years ago where we went into regenerative growth, where we said we want to invest in things that really have this ability to, if not add resources to the planet, at least not use as many resources. And by nature of the technology that the companies are invested in, create a lot more value for a sort of declining cost curve. Looking for those types of investments. Tesla is of course our biggest position. And then we had other positions, and Twist Bioscience was one of them. So we invested in Twist Bioscience and we decided to exit. And this exit is unique because it's an exit where we assume that we were wrong. This is not a good company. This is the thesis. When we got out of Microsoft or CRISPR Therapeutics, it's not because we thought they're bad companies. It just didn't fit our portfolio anymore. This is not a good company, and it's not a good company because Twist Bioscience is not making money. And if you don't understand how a company gets the profit, if you don't understand where the profits come from, then maybe you're the profit. I spoke about this yesterday. In other words, if you as an investor, you don't understand where the profits come from within your portfolio companies, then maybe you are the profit. They're pulling you in, taking your capital, paying themselves nice salaries, and then one day they'll just say, sorry, didn't work out. I'm going to go do something else. You have to be very careful as an investor. This happens, and this is not even illegal. I'm not claiming that what Twist Bioscience is doing is illegal, but here's what I think they're doing. They're selling the product at a cost that is not sustainable. In other words, they're underselling the product to generate growth, because growth companies are priced as a multiple of sales. So the more sales you have, the higher a multiple, the higher market cap and all of that stuff, even though, in fact, you're not making money. Let me give you an example. So you could sell 10 items for a profit, or you can sell 20 items for a loss. You will choose to sell 20 items for a loss because the 20 items will give you more revenue and therefore a higher market cap. This worked for a while. Twist Bioscience went from about 1 billion to almost 20 billion in market cap, which is a lot of money for a company that this year is going to have 200 million in sales. So we're talking 100 times, almost 100 times sales. It's absurd. And you might think, well, Krim, what were you doing? I mean, you were long. We bought the stock at 30. It went to almost, I think, what was it, 200 or 180 or whatever, doesn't matter. And now it's back to 30. So we haven't lost a lot of money. I mean, we lost very little money. Maybe we bought the stock at 30 and we sold it at 29, something like that. It doesn't matter. Details. This wasn't a loss-making trade. It was loss-making because it tied up capital, but we gained from it because we learn. We learn a lot here. What do we learn? Okay, we invest in a company that is in the SynBio space. They do something like synthetic DNA. First caveat, I don't understand what synthetic DNA means. I just don't. I tried to understand. I read about it. I did courses, EDX, about DNA and synthetic DNA. I don't understand what it is. This is on me. It's a little bit on Twist because they're not able to explain it either. And if they're not able to explain it to me, then maybe they don't understand it or they don't want me to understand it. Now, whatever it is, it's not a good thing. The second business line that they have is NGS, Next Generation Sequencing. The name itself is already churning my stomach. What does this mean, Next Generation Sequencing? Sequencing is a new technology, and now you already have a next generation, but nevertheless, there's a legitimate business here because you need some of their products to formulate the gene sequencing. Gene sequencing is an important business. We still invest in PacBio, because if you want to have a genomics revolution, if you want to think about how to do biology and bioscience from first principles and digitize it and make it an engineering science, you have to first understand to read whatever you're exposed to. In other words, you need to sequence. I think this business is legit in the sense that it's a real business. There's real demand. The question, though, and this applies to the first business segment, which is synthetic bio, and the second, next generation sequencing, it seems to me it's a commodity business. You can't really make money because they keep growing and not making money. I'm going to get to the numbers a bit later. I'm going to explain what it means, because they claim that they have a 40% gross margin, and I think that's wrong. Now we're going into, I call it snake oil territory. Why? And this was part of the reason why I was so excited, but now I understand maybe I was wrong. The third business segment is, they call it biopharma, whatever that means. Again, I kind of vaguely thought I understand what they're doing there, which is building libraries of molecules that could be helpful to maybe in a digital way, machine learning way, understand how to develop drugs from first principles. This was my thesis. I thought this could be such a great thing. And maybe it is. The problem is after 3 years, there's barely any growth. On their slide, the way they talk about this business is we have 70 projects running. That's not something you should be bragging about. What you should be bragging about as a business is we have X customers that are paying Y dollars, and this is the profit we're making. If you have something good, people want it. And if you have something good that people want, it's because it gives value at a decent price. And then you also want to be able to lower the cost continuously and grow exponentially. Otherwise, I'm not interested, particularly when you trade 100 times sales. So this, to me, given that after so many quarters, they keep growing, but it's just not happening in terms of even growth. Like, I understand, let's say, there are companies out there, they go from 50 million to 200 million to a billion. Sigma, for example, a good example. So there are companies that grow, have exponential growth. Even Tesla had it and still has it, although it's not exponential anymore. It's becoming difficult. But my point here is, to me, it just seems a bit like either it's snake oil or they tried something and it's not working. The fourth business segment is DNA storage. Sounds incredibly interesting. And I think that's one of those things. I had an episode about, I think it was 2 years ago, where I spoke about disruption and I discussed Clayton Christensen, and I used TWST as an example of disruption in a Clayton Christensen way, or I want to say orthodox way, orthodox disruption. So really get back to the scripture, which is Clayton Christensen's book, The Innovator's Dilemma, and then really go very carefully, understand what is Christensen saying in the book, and then try to apply it to TWST Bioscience. And what Christensen's saying in the book is that true disruption, or disruption, let's skip the word true, starts with a product that has no demand because it doesn't exist. Like, whatever they do either has no demand, people don't even know it exists, or it's at such a, it wasn't possible before. So people want it now, but before they didn't even know that they want it because it couldn't be done. So anyway, what is DNA storage? It's a way to store data using DNA. And what's good about it is the main advantage that I saw and still see, and that's also what Emilio Proust, the CEO of TWST, says, well, it's good for long-term storage. Long-term being 100 years, 200 years. Now, I was thinking, well, that's one of those things, and back to the scripture, back to Clayton Christensen, what is long-term storage? Well, we don't even have that today. The longest storage we really have is maybe 30 to 50 years, something like that, and then we have to refill it. So we're kind of getting into that area right now where, because we're kind of like, 70 years into the digital revolution when you start 1950. So we have this problem, let's say, how can we store the US Constitution in a very long-term way? How can we store, maybe blockchain technology could get into that problem, right? Can we store some of the blockchain stuff somewhere where it holds? If the Bitcoin technology, the protocol actually becomes the global standard for digital value and maybe even payments and all that, maybe we want to store some of it somewhere, but in a way that we can, reliably think of it, that it's going to be there for centuries. Maybe, we're using Bitcoin technology when we go to Mars, so we want to take something with us, and we don't want to have to come back after 50 years and replan. Whatever it is, look, when you talk about disruption in a Clayton Christensen type of way, you really don't even know what you're talking about, because when YouTube started, YouTube was a dating service. Nobody was talking about education on video online, or chat rooms, super chats, MMA coaches talking about fights on YouTube. That wasn't what YouTube was designed to do. But of course it grew into that. So in other words, disruption just brings in lots of interesting use cases. Anyway, that's how we saw DNA storage. And I still have to say the jury's out there. This is one of those things where they need time to develop the technology. So worth investing and partly justifying the high valuation, because back then we had that problem. How do you justify 100 times sales for a company that in its core business barely makes money, or makes no money, and has two other businesses that are growth, one of them questionable, the biopharma, and the other one great, but really cool about this. Like, is this real? Is it not real? And when I go to hardware conferences, memory conference, all that kind of stuff here in Silicon Valley, nobody talks about DNA storage. So it's a little bit like, it could be, I've been there before. I went to battery conferences 5-6 years ago. Nobody spoke about Tesla. Okay, so the one company which is changing the battery technology around the world, nobody talks about them because incumbents don't want to talk about them, all that stuff. So now let's get to the real gist of the reason why we sold Twist, which is the numbers. So let's just look at the most recent quarterly report. Sales for the 9 months of 2021, 94 million. 2022, 146 million. So growth about $50 million, which on 94, let's say 50% growth. That sounds good. What's the problem? The problem is that the operating loss went up even more. So their expenses grew more than the revenue. So if they have 50 million more in revenue, the expenses grew by a staggering 100 million. This is the problem. SG&A went up by 60 million. So SG&A alone grew more than the sales growth was. And then there's, cost of revenue and things like that. So total 100 million. Now here's the thing. Look, you can have years where that happens. That is possible. When a company expands fast, they might have a very large expense right now. Stuff like that. And I spoke about this yesterday. You could have a situation where a company for a while doesn't make money. Let's say when you built the Golden Gate Bridge, or when Tesla was building out factories, particularly in the early days when there was not a lot of revenue. But here's the problem. This company is not in that situation. This company is growing their revenue. So they are growing. It's not like the Golden Gate Bridge where there's no revenue and only expenses, or Amazon where you're building out infrastructure and things like that. Well, Amazon maybe was. Anyway, the point is this. What I suspect is going on here is that they're subsidizing their revenue. This is what I suspect. And that's why we sold the stock. This company is doing something that unfortunately has become a common game in Silicon Valley, or I don't even want to say Silicon Valley, but in the startup community. WeWork was like that. Many companies, particularly actually outside of Silicon Valley, these so-called new generation startups, blah, blah, blah. Particularly if you go to an investor conference, startups in New York, that's very dangerous. Miami, very dangerous. Austin, not so dangerous. Silicon Valley is still fine. So if Berlin, Lisbon, Barcelona, all these fancy towns, they have all these tech entrepreneurs. What do? They have a company and they subsidize sales because the only thing they care about is sales, sales, sales. So they hope to sell to somebody, either another company or another VC or another PE company, or even worse, some Fidelity or mutual fund that wants to be a VC. What does it mean to subsidize sales? Well, if I have a product that costs me $10 to make, I should be selling it if I want to have a 40% gross margin, I should sell it at, $14. But maybe if I sell at $14, my growth will be very limited. So if I sell it for, let's say, $8, I can grow a lot. And if I do that, I can show sales growth, and then I can park. And here's what a lot of these companies do. They say that I'm going to sell the product for $14 and then charge a $6 marketing cost. So what I really sell it for is $8. But on the books, it goes out for $14, and then I have a $6 charge marketing. So that's why SG&A is growing so much. Selling, general, and administration grows more than your sales growth. Some of it is you have more sales reps and that kind of stuff. Okay, I get it. But there's just this suspicion. I call it the Blue Apron effect. Why? Because Blue Apron was the first company where I saw this years ago. Blue Apron was a company that was selling prepared meals and delivering to your home. And my neighbors used to buy it, and I was like stunned because they bought food that was at the same, if not better quality than the food that I was buying at Whole Foods for less money. Now, the portions weren't exactly the kind of portions I'm used to. So for me, it was never an option because if I had to order as much as I just eat a lot. And anyway, long story short, but I was still wondering, you have a wild salmon, some vegetables, all that kind of stuff that I like to eat. And that costs me, my dinner at Whole Foods. If I go and buy the thing at the counter and then cook it, I'm looking at $20-$30. It's just that's the price of a good piece of wild fish. Same good piece of steak, or you want nuts, vegetables, whatever you eat. So my point is, how are they able to deliver this food at that price? And they were claiming 40-50% gross margins. And then you're like, okay, well, great, but your losses keep increasing with sales. Well, what happened is the price wasn't right. Same with Uber, for example. Uber is that kind of company. So a lot of companies started doing that, and the results are that they fail. So I think my suspicion is the TWST is that kind of company, and that's why we sold. So to summarize, we decided to sell TWST today. The reason we decided to get out of this position is because it looks like the potential that we saw in the company is not materializing. It looks like the company is not able to provide the kind of value that we as investors expect the company to provide. And if you don't understand where the profits come from, then maybe you are the profit. In other words, it looks like this company is simply banking on the fact that we keep buying their stock and they're paying themselves nice lifestyles, but they're not able to provide the value. Now, I'm not saying they're a fraud, but it's just a convenient way to make a living at the expense of investors. And it's our job, it's our fiduciary duty to not be caught in a scheme like that. Again, I just want to make sure this is not a claim of fraud. So I don't have any problem with TWST as a company. Do whatever you're doing. I hope it's not a fraud. But for us, this is not an investment we're interested in, because if you keep growing your sales and your costs keep growing even more, if you show me a gross margin, but then your SG&A keeps growing even more, that means you're subsidizing your sales. And I don't want to be invested in something like that. And on the flip side, I want to end on a positive note. What is a business we like? Is a business that grows sales, has a good gross margins, and has operating leverage, which means that the SG&A is not growing disproportionately, actually underproportionately with sales. That's a good business. That means that you keep adding value. Your infrastructure, your knowledge, your technology is able to add value to customers while you're able to make a profit. That's the kind of business that we're interested in. For everybody else, that's fine. There are business models out there that we might not understand or not be interested in, but we are interested in operating leverage. Invest in know-how, in technology and infrastructure, and then build a business around value, and that has to be reflected in profits. Thank you.